I'm Brad Chastain, Director of Education at U.S. Money Reserve. For over 18 years, I worked at Vanguard, one of the largest investment firms in the world. There I worked as a retirement counselor, helping clients plan and prepare for retirement, and then as a manager of retirement education. As any financial advisor will tell you, diversification is the key to creating a successful portfolio. And while you may believe your portfolio is already diversified because you have a mixture of stocks, bonds, mutual funds, or annuities, it may not be quite as diversified as you think. Today, we're going to talk about what you can do to get the most out of your diversification strategy. No one knows what the future will hold or how any one asset or asset type might perform at any given time. This is why your diversification strategy, how you allocate your money among various asset types, is one of the most important decisions you can make for your portfolio. What do I mean by asset types? What I'm talking about are the various categories of assets, such as stocks, bonds, real estate, precious metals, or cash. These are all different asset types. Why are your decisions regarding these asset types so important? Because each type of asset has its own risks and benefits, and performs in a different manner. In other words, each asset type can play a unique role in your diversification strategy. For example, stocks can be highly volatile and are vulnerable to political and economic events. Bonds are loans. They're affected by changes in interest rates, a borrower's ability to repay the loan, and inflation, since the dollars the borrower is repaying may not purchase as much in the future. Real estate and precious metals experience shifts in demand, and cash is losing purchasing power due to inflation. However, the positives of each of these asset types do outweigh their risk when used for specific goals and objectives. For example, due to its stability, cash can be the best option for short-term needs, current living expenses, or money we expect to spend within the next year or two. Real estate and bonds can provide income. Stocks and gold can provide long-term price appreciation and inflation protection. Because each of these asset types performs differently and has different risks, they can work together to strengthen your portfolio as a whole. When something is happening in the world that negatively impacts one or two asset types, the others may be unaffected or even respond by moving in the opposite direction. In this way, they work together to protect your portfolio from any one particular risk. In short, diversification can help shield your portfolio when things aren't going well and help your losses recover more quickly when things turn around. Take gold and stocks, for instance. While both can provide long-term profit potential and inflation protection, they typically perform very differently and don't share the same risks as one another. During times when stocks have fallen, gold has often acted as a safe haven. This is exactly what we are looking for when we talk about diversifying across asset types. Studies show that over the long term, more than 90% of the returns of a portfolio are determined by the mixture of asset types you select, called your asset allocation. Less than 10% comes from the timing of when you buy. This is why choosing an asset allocation appropriate for your time horizon is the most important decision you can make when building a portfolio. While each asset type can play a role in your portfolio regardless of your time horizon, someone further from retirement may choose to have a higher allocation to more volatile assets like stocks, and someone closer to or in retirement may choose to have a higher allocation to less volatile assets such as bonds and wealth-preserving assets such as gold. Now, taking asset allocation one step further, it's important to also diversify within each asset type. If you own mutual funds, there's a good chance you already have diversification of your stocks and bonds. Take stocks, for example. Your mutual funds may own a mixture of small and large companies. They may also own stocks in different industries, such as manufacturing, technology, energy, and healthcare. With bonds, they may own short-term and long-term bonds. Real estate investors often own residential and commercial properties. Similarly, you have many options when it comes to precious metals. You can diversify with gold, silver, platinum, and palladium, bars or coins, even inside or outside of an IRA. Each has its own features and performance characteristics that can add a level of diversification. So how do you go about getting the diversification you need? No single individual is completely versed or an expert on all areas of finance and asset types. So many people find it helpful to build a financial team of professionals to help in each specialized area of their finances. Your team may include a financial advisor that specializes in assets such as stocks, bonds, or mutual funds, who can help you make sure you have those assets diversified properly. An accountant or tax professional can help you with your taxes. A real estate professional can help you navigate purchasing and owning rental property or land. And your account executive at U.S. Money Reserve can help you understand and diversify with physical, hard assets such as gold and other precious metals that have been proven to help diversify and protect a portfolio. Call U.S. Money Reserve today to speak to an account executive about how precious metals can help you achieve the diversification and wealth protection you and your family deserve.